Welcome, everyone. We are just thrilled to have you sitting down with us today for another deep dive.
Yeah, it is great to be here. We've got a really fascinating one for you today.
We really do. And if you're joining us, you know the drill. We've spent the week analyzing a huge stack of financial research, market data, economic reports.
Very dense stack this week, I'd say.
Extremely dense. But we are pulling out the most critical insights so you don't have to.
Yeah.
And today, we're focusing on the pulse of the broader stock market.
Right.
And the data we're looking at is pointing to a highly unusual scenario. We are basically looking at a market that is, well, it's essentially suspended in midair.
It really is a fascinating dynamic to observe because the core takeaway from the sources you shared is that the broader market has made zero net progress since November.
Which is wild to think about.
It is. It hasn't necessarily suffered a massive collapse during this stretch, but it is completely treading water.
And I mean, that feels counterintuitive, right? Considering the sheer volume of news we see every day about market highs and tech innovations.
Yeah.
But the research we're looking at suggests this treading water phase isn't just a benign pause. Our sources actually identify this specific kind of stagnation as a subtle structural red flag.
Yeah, historically speaking, a market that simply jogs in place for months, it's signaling underlying exhaustion. The data highlights that several stalwart stocks, specifically major players in the artificial intelligence space, have seriously struggled recently.
Especially after releasing some pretty lackluster quarterly numbers.
Right. And the hesitation we're seeing is the classic precursor to a market pullback. Basically, investors are stepping back and recalibrating their risk.
And recalibrating that risk is exactly our mission for today's deep dive. We are going to explore what actually happens if this AI-driven market bubble that has defined the last couple of years actually pops.
A big what if, but a crucial one.
Definitely. And to do that, the source material zeroes in on three massive, high-profile companies that are uniquely vulnerable to a severe market sell-off.
We are looking at a very specific cross-section of the global economy here, just to illustrate how interconnected this vulnerability is.
So to map it out for you, we'll start with the poster child of the AI boom, then we'll move to the underlying hardware monopoly that makes the entire tech ecosystem possible.
The one behind the scenes.
Exactly. And finally, we'll examine how a tech stumble ultimately fractures the bedrock of traditional finance.
It's a domino effect.
Okay, let's unpack this and start right at the top of the food chain, Nvidia,
The big one.
the behemoth. The source material argues that if any single name is going to lead the market lower, it's the exact same company that has led it higher since 2023.
Which makes sense.
And the scale of this climate is almost difficult to comprehend. We're talking about a stock that has seen a 1,100+% gain.
Staggering.
Right. It sits on a $4.5 trillion market cap, making it the world's biggest publicly traded company, with shares hovering around $183.
What's fascinating here is that the sheer velocity of that multiple expansion, it's historic. But the charts in the source material reveal a glaring divergence from the public narrative.
How so?
Well, despite that massive valuation, Nvidia hasn't actually made any forward progress since August of last year.
Wait, since August?
Yeah, since August.
But we've seen endless headlines about AI investments, new data centers being built, massive corporate spending since then. How is it possible the stock hasn't moved in all that time?
It sounds totally counterintuitive, but the charts don't lie.
Yeah.
What we're seeing right now is the market pricing in a, well, a prove-it phase.
A prove-it phase.
Exactly. The initial surge was based entirely on the promise of what artificial intelligence could eventually do. But now the market is scrutinizing the actual return on invested capital.
The ROIC.
Right. Investors are looking at tech giants spending billions upon billions on AI infrastructure, and they're asking a very dangerous question.
Which is?
Is this massive capital expenditure actually yielding sustainable, profitable results?
Wow. So I want you to imagine the anxiety of that infrastructure build-out. You have these companies pouring cash into AI, and the market is starting to fear that too much money is chasing too few actual use cases.
And the historical parallels here are just hard to ignore. Think back to the Cisco.com era.
Oh, that's a great comparison.
You had a company providing the undeniable picks and shovels for a revolutionary technology, which was the internet back then.
Right. Everyone needed their routers.
Everyone. But when the telecommunications companies realized they had overbuilt their capacity and the immediate consumer demand just wasn't there to justify all that CapEx, the spending stopped basically overnight.
And the infrastructure provider took the hardest hit.
Exactly.
And the research points out that Nvidia is incredibly exposed to that exact kind of sudden stop because their revenue concentration is heavily skewed.
Very skewed.
Data center processors now account for a massive 75% of the company's entire top line.
And that 3/4 of their revenue is absolutely their Achilles heel.
Because it's all in one basket.
Yes. While their processors remain the computing heart of most new AI data centers, that level of concentration means their fortunes are entirely tethered to one specific behavior.
The unbridled, continuous expansion of AI server farms?
You nailed it. If the broader economy runs into headwinds and those tech giants decide to stretch out their deployment timelines or delay their CapEx budgets, the demand for those specific chips doesn't just slow down.
It faves dramatically.
It evaporates.
But the report points out that Nvidia isn't even the base of this pyramid. There's a tantalizing detail in the source text highlighting an indispensable monopoly sitting in the background.
Yes, the quiet giant.
Right. A company that owns the underlying technology that Nvidia, AMD, and Intel absolutely rely on to manufacture their chips. They need it to function.
And that brings us right to our second vulnerability, which is ASML Holding.
ASML.
They are the Dutch monopoly your source is pointing to, and their position in the supply chain makes them incredibly sensitive to the exact capital expenditure cycles we were just talking about.
Let's unveil this hidden giant for a second. They currently have a market cap of $527 billion.
Not small by any means.
No, not at all. With shares trading around $1,368. And what they do is highly complex, but the source breaks it down to the essentials of modern chip manufacturing. They specialize in extreme ultraviolet lithography, or EUV.
Which is like science fiction when you really look at it.
It really is. And just to be clear on the mechanics here, for you listening, they aren't just snapping pieces of silicon together. The source describes it as spraying raw materials into semiconductors. These machines use extreme ultraviolet light to etch complex patterns at an atomic level.
It is arguably one of the most sophisticated engineering feats on the planet right now.
It's mind-blowing.
And ASML holds a massive patent portfolio that effectively locks out any real competition. They own this highly specific, utterly vital sliver of the chip-making market.
A true monopoly.
A true monopoly. But maintaining an undisputed monopoly on bleeding-edge hardware comes with a massive structural risk, and that is the price tag.
Right.
A single EUV machine costs around $400 million.
$400 million for one piece of manufacturing equipment.
One machine.
The CapEx required to build out a fabrication plant using these machines is just staggering.
And that price tag is exactly why they are so vulnerable. The data in your source highlights a stark disconnect between the current market hype and the reality of ASML's actual order book.
Okay, lay the numbers out for us.
Well, last year, the company sold 300 new EUV systems.
Okay.
But in 2024, they sold 380 machines.
Hold on, walk me through that. Their actual sales volume dropped by 80 machines?
80 machines.
At $400 million a pop, that is a massive hit to their top line.
Huge.
Here's where it gets really interesting, though. The source notes that ASML's stock is somehow up another 35% just since the end of last year.
Despite the drop in sales.
How does the market justify a 35% bump in valuation when the core product sales are dropping that severely?
The analysis bluntly calls this wishful short-term thinking.
Wishful thinking.
Yeah. The market is currently operating on the assumption that the global need for computer chips will simply grow into infinity, totally regardless of macroeconomic conditions.
Which is a dangerous assumption.
Very. And that assumption has driven ASML stock up to nearly 50 times this year's projected profits, which are estimated at roughly $29.65 per share.
Trading at 50 times forward earnings while unit sales are actively shrinking, that sounds like a recipe for a violent correction.
It is. So what does this mean? It means this is a stock priced for absolute perfection in an increasingly imperfect macroeconomic environment.
Right.
When a company relies on selling equipment that costs nearly $500 million, their backlog is entirely dependent on the extreme confidence of their buyers.
Because you don't buy a $400 million machine on a whim.
Exactly. Even the slightest hint of economic weakness causes these chip manufacturers to balk. They don't necessarily cancel the orders entirely, but they delay them. They push a 2026 delivery into 2028.
Oh, okay.
And for a stock trading at a 50x multiple, A delayed order is just as devastating as a canceled one. If the AI pullback materializes, those massive capital expenditures are the very first things to get deferred.
Which perfectly illustrates how fragile the top of the tech food chain might actually be right now. You have Nvidia relying on continuous data center expansion, and ASML relying on the chip makers having the confidence to buy $400 million machines just to make Nvidia's chips.
It's all connected.
But the source material takes this a step further. It asks us to look beyond the tech sector entirely to see where the real structural damage of a pullback would land.
Because if we connect this to the bigger picture, an AI bubble bursting doesn't just happen in a vacuum.
Yeah.
It triggers a broader market weakness, and that weakness bleeds into the wider economy. Which brings us to the third company identified in your sources.
JPMorgan Chase.
JPMorgan Chase.
Pivoting to traditional finance. They are the bedrock of traditional finance, sitting on a $792 billion market cap, trading around $293 a share.
A massive institution.
Now, at first glance, you listening might wonder how an AI pullback could possibly hurt a traditional banking giant. Why would they be uniquely vulnerable to an overvalued Dutch lithography company or a slowdown in data center builds?
It comes down to the mechanics of economic velocity.
Okay, break that down.
JP Morgan isn't directly exposed to the failure of an AI startup, but they're directly exposed to the macroeconomic stagnation that follows a tech crash.
The ripple effect.
Exactly. When the broader market pulls back, capital freezes. And when capital freezes, it crimps almost every single revenue stream a massive banking institution relies on.
Let's collaboratively break down exactly how this impacts their specific revenue streams, because the source provides great detail here. Let's start with mergers and acquisitions, alongside their consulting and advisory business.
Okay.
This makes up about 10% of JP Morgan's revenue. Why does a tech stumble kill M&A?
It's boardroom psychology. If an AI pullback spooks the market and stock prices drop, corporate boards embrace a wait-and-see mindset.
They get scared.
Right. No CEO wants to authorize a massive strategic acquisition and take on the associated debt when the market is volatile and their own company's stock might be falling.
Makes total sense.
They hold on to their cash and they cancel their advisory contracts. So that 10% of JP Morgan's revenue effectively dries up overnight.
Wow. Then the research points to their equity trading business, which is another 20% of their total revenue. I assume this follows a similar logic.
It does.
Because if the market is just treading water or actively pulling back, the trading volume just disappears.
The volume absolutely tanks. Retail and institutional investors alike need a compelling reason to deploy capital. If the prevailing sentiment is hesitation, they see no good reason to buy stocks.
They just sit on the sidelines.
Exactly. And if clients aren't trading, the bank isn't collecting fees, and their equity trading revenues crater.
So that is 30% of their revenue severely impacted just by the market losing its momentum.
But the source indicates the real structural risk sits with the remaining half of their business.
The net interest income.
Yes. This is the biggest liability for JP Morgan Chase, and really any major traditional bank. Net interest income accounts for roughly 50% of JP Morgan's total revenue.
Half their business.
Half. This is the absolute core of banking, taking in deposits and lending out money.
Right.
The text explains that periods of economic malaise inevitably lead to lower interest rates as central banks try to stimulate a struggling economy.
And lower interest rates compress the bank's profit margins.
The math gets brutal here. The spread between what the bank pays out to depositors and what they collect on loans shrinks dramatically.
But margin compression is only half the problem.
Right. General economic weakness destroys the actual demand for new loans entirely. Think back to those tech companies delaying their $400 million machine orders.
Right, the ASML machines.
Yes. That delay means they aren't borrowing money from banks like JP Morgan to build the factories to house those machines. Small businesses don't take out loans to expand if they anticipate a recession either. So JP Morgan gets hit with a dual threat. Their profit margins on existing loans squeeze, and the sheer volume of new loans evaporates.
That is 50% of their revenue highly exposed to an economic ripple effect started by a pullback in tech capital expenditures.
It's all linked.
Now, the source makes a point to clarify something important. This wouldn't threaten JP Morgan with insolvency. A tough year for a fortress balance sheet of this size is manageable compared to smaller regional banks.
The danger here isn't bankruptcy.
Right, it's valuation contraction, because right now, this particular bank stock is priced as if none of this risk exists. priced for blue skies forever.
But the technical charts are starting to tell a very different story.
What are the charts showing right now? Let's look at the data.
The data notes that institutional investors may finally be starting to price in this macroeconomic risk. After peaking in January, JPMorgan shares have made a series of technical moves known as lower lows followed by lower highs.
That pattern, a lower low followed by a lower high, that is a classic indicator of a shifting tide.
It's the physical manifestation of doubt entering the market.
Yeah.
And the vital takeaway from your source material about how sell-offs happen is that they don't always start with a crash.
Right.
They rarely start with a massive, catastrophic crash that catches everyone by surprise on a Tuesday morning. They start subtly and slowly.
The leak.
Exactly. A lower low here, a lower high there. The momentum slowly degrades as the smart money quietly exits, until the broader market realizes the fundamentals no longer support the valuations.
So what does this all mean? Synthesizing the journey we just went on today, we are tracking a profound web of interconnected risks.
We really are.
We started by examining a broader stock market that has been completely treading water since November, masking an underlying exhaustion. We looked at Nvidia's staggering 1,100% climb and realized their $4.5 trillion valuation is heavily over-reliant on the continuous, unbroken expansion of data centers, even as the market enters a prove-it phase regarding actual AI profitability.
And from there, we trace the hardware supply chain to ASML Holding, a monopoly selling $400 million lithography machines,
Right.
whose stock is overpriced, trading at a 50x multiple even as their actual unit sales drop, leaving them incredibly vulnerable to delayed CapEx cycles.
And finally, we followed that delayed capital expenditures straight into the balance sheet of JPMorgan Chase, a bedrock bank whose core loan demand, M&A advisory, and trading revenues are deeply exposed to the economic ripples that an AI pullback would trigger.
It perfectly highlights how a localized speculative bubble eventually becomes a macroeconomic reality.
It does. And as always, I want to remind you, the listener, that our goal with this deep dive is simply to provide an impartial look at the source material you've shared.
We're just reading the tea leaves of the market data.
Exactly. We are not endorsing fear, predicting the future, and we certainly aren't guaranteeing a market crash. It is just about understanding the mechanics of vulnerability that currently exist, spotting the structural cracks before they widen.
And looking at those structural cracks leaves us with a final, I think, really provocative thought that builds on what we've discussed.
Let's hear it.
If a single sector's hype, like artificial intelligence, can artificially inflate everything from the stock price of a Dutch company making $400 million light machines, all the way to the loan margins of the world's largest banks.
Yeah.
What happens to the global definition of economic growth when we realize it might be entirely tethered to just one fragile, unproven technology?
Wow. That is a question that demands some serious thought. Thank you for joining us on this deep dive today. We always love analyzing these complex market dynamics with you. Keep questioning the world around you, keep scrutinizing the data, and we will see you next time.